Hello everyone, this is Phil Yaeger, and I want to welcome you to a financial accounting video. And one of the areas I'm going to talk about, which is going to affect January 1st, 2019, is the new lease area, Now, what I've decided to do is to read the blueprints. Now, before I talk about the blueprints, let me just tell you, about 45 minutes to an hour ago, I got a call from a student who was calling about regulation. And he didn't pass regulation. He was not one of our students. He took one of the other courses. And I said to him, did you follow the blueprints? And he said, what are the blueprints? Now, normally I wouldn't talk about this, but that really burned me up because we integrate the blueprints in our books, whether it's the financial, reg, BEC, or auditing. We integrate them, because that is the task you must know to pass the CPA exam. If you don't know the tasks, then how are you going to pass? All right. Well, I'm going to tell you that he mentioned 2 courses he bought materials from, and none of them has the blueprints. He didn't even know what the blueprints were. Now, the exam has been around now with the new blueprints, I think roughly about 2 years. And I'm thinking to myself, what are our competitors doing? They should be ashamed of themselves that they don't tell the students about the blueprints, because the AICPA examination division tells us, course providers, that you have to tell the students about the blueprints. And if you don't study the blueprints, you're not going to know what they're going to ask you. You're basically like, if I was bowling, all right, it would be like bowling without being able to see the pins that I'm bowling. All right, please do the blueprints. So what I'm going to do today with the leases is I'm going to read to you the new blueprints for the period starting January 1st, 2019. All right, and we'll elaborate on some of them. All right, now, first blueprint says identify the criteria for classifying a lease arrangement. All right, now, basically, there's 2 types of leases to the lessee. There's a finance lease and an operating lease. The word finance lease replaces the old capital lease. There's no longer capital leases. So it's a finance lease or an operating lease. And we're just talking about to the lessee. Now, how does the lessee determine, all right, if it is a financing lease? Now, under the old capital leases, we used to say that if the lessee met one of the owns requirements, OWNS, then it's a capital lease. But now, all right, what's the criteria for being a finance lease? Well, they're similar in this way. First of all, the first requirement is this. If the lessee meets the O of owns, all right, which says ownership transfers to the lessee at the end of the lease, then the lessee will treat it as a finance lease. All right. Second requirement. Is there a written bargain purchase option, which means can the lessee buy it out at less than fair market value at the end of the lease? If you meet the W test, a written bargain purchase option, then the lessee will treat it as a finance lease. Now, the next test is the N test. Now, under the old capital leases, it said that if the present value lease payments were 90% or more of the asset's fair value, then it would be a capital lease. But they've changed that. And this is what it says now. All right. The N test says the present value of the minimum lease payments required under the lease equals or exceeds substantially all. All right. Now, if they don't tell you what substantially all is, all right, there's a presumption that substantially all means 90% of the fair value. So the present value of lease payments equals 90% or more of the fair market value of the leased asset. That's the presumption if it says substantially all. Now, could they own, all right, could the present value of lease payments be 70% and still be substantially all? Yes, because if they say the present value of lease payments is 70% of the fair value, and that represents substantially all right, of the fair value of leased assets, then it meets that test. It's sort of like significant influence in the equity method. All right, if you own 20% or more, there's a presumption you can exercise significant influence. Now, that's if they don't tell you. But you could own 10%, and if they say the company owns 10% and they can exercise significant influence, then they have significant influence even though they own 20%, less than 20%. So now it's saying if the present value of lease payments, all right, substantially all equals, all right, the greater of the present value of the lease payments. I said that wrong. If the present value of lease payments is equals or exceeds substantially all right, there's a presumption that that's 90%. But remember, substantially all can be met if they say they own 70%. It's 70%, the present value of lease payments, and that represents substantially all of the fair value of the asset. All right, so I want to get you to understand this. In the standard, it doesn't mention the 90%. It used the word substantially all. All right, now the next test is the S test. Now, under the old capital lease, if the lease term was 75% or more of the normal economic life, then it was a capital lease. Now, the 75% is no longer mentioned in the standard under the new finance leases. All right, the wording is the lease payment, the lease period is a major part. Now, if they say the lease period is a major part, all right, there's a presumption that the lease period is 75% of the normal economic life. Now, what happens if it said the lease period is 6 years of the 10-year economic life, and that is, all right, a major part of the remaining economic life? Then, even though it's 60% or 6 years of a 10-year lease, 60%, if it says it's a major part, the lease term is a major part of the economic life, then it meets that test. All right? So, remember, substantially all is in lieu of the 90% test, but if you say substantially all, then you're assuming that the present value of lease payments is at least 90% of the asset's fair value. Now, if it says the lease term is a major part of the asset's economic life, there's a presumption that that is 75%. Now, there's a new test called the alternative use test, the AU test, alternative use test. And it says the leased asset is specialized to the point that the lessor will not have another use for it if not leased by the lessee. So what it's saying here is this: if the lessee is the only one who can use this because the lessor developed it just for the lessee's use, then obviously, all right, the lessee sort of owns it, if you think about it. All right? Now, remember, you have to meet one of those criteria. If you meet one of those criteria, what's going to happen? All right, it is a financing lease to the lessee. Now, what happens if it doesn't meet any of those criteria? Then it's an operating lease to the lessee. Now, what about to the lessor? All right, if we have a finance lease to the lessor, all right, I'm sorry, I said that wrong. If we have a finance lease to the lessee, it's a sales type lease to the lessor. Finance to the lessee, sales type to the lessor. If it's an operating lease to the lessee, it's an operating lease to the lessor. All right? So that's the criteria for determining a leasing arrangement. I read to you the blueprint. All right? The next blueprint, calculate the carrying amount of leased assets and liabilities and prepare journal entries that the lessee should record. And then the next blueprint says, calculate the carrying value of leased related assets and prepare journal entries the lessor should record. Now, whether you have, all right, if the lessee has a finance lease or if the lessee has an operating lease, all right, the lessee still records this transaction. Now, let me go over this with you. Whether the lessee has a finance or the lessee has an operating lease, all right, the bottom line is this: the only thing the lessee has is a right to use the asset. It's no longer where we assume that the other party, if it's a finance lease, all right, you're not assuming that they what? Own the lease, the lessee. All right? All you're assuming under the new standard is that the lessee, whether it's a finance or operating lease, please remember that that lessee has a right of use. So the asset we record, whether the lessee has a finance lease or an operating lease, is a debit to a right of use asset and a credit to lease liability. All right, that's what the lessee does, whether it's a finance lease or an operating lease. Now, if it is a finance lease to the lessee, the lessor will treat it as a sales type lease, which means that the lessor is selling it to the lessee, and the lessor will record a sale. All right, so this would be the entry. They'll debit lease receivable for the full amount of the asset's fair market value. They'll credit sales or revenue for that same amount, and then they'll transfer their inventory, the cost of the inventory, the cost of goods sold. They'll debit cost of goods sold and credit inventory. Please remember that. All right, so remember, there will be no depreciation to the lessee, all right, if the lessee records it as a finance lease or even an operating lease. Because in lieu of a fixed asset being recorded by the lessee is recording an intangible asset called right of use asset and crediting lease liability. Now, the right of use asset has to be amortized. Why? Because we use the word intangible assets, we amortize them. We don't depreciate the right of use asset. Now, the next thing, let's talk about accounting for operating leases for the lessee. Now, please note this, all right? The accounting treatment is for the lessee in an operating lease to record a right of use asset and credit a lease liability. And then what will happen is, all right, the lessee will actually make the lease payments by debiting lease liability and credit cash. Now, what about the accounting treatment for operating leases for the lessor? All right, well, the lessor will record, once again, what? The lessor is doing what? He's just renting it. So the lessor in an operating lease is going to do what? He's going to debit cash and credit rental income. And because it's an operating lease to the lessor never gives up right of the asset to the lessee. All the lessee is getting a right of use. So the lessor in an operating lease will continue to depreciate the asset because they maintain control of that asset. All right, here's the next blueprint. I'm not explaining this in great detail right now. I just want you to have some idea what we're talking about. All right, now, the next thing, next blueprint. I'm reading exactly from the AICPA Blueprint. Calculate the lease cost that the lessee should recognize in the income statement. Well, there's two types of costs. The lessee can have executory costs, which are normal expenses when owning a leased asset. And they include insurance, maintenance, taxes that have to be paid as a result of leasing the asset. Now, how you handle these executory costs depends upon whether the lease is a gross lease or a net lease. Do you know what a gross lease is? Probably not. A gross lease is where the lessee will make fixed payments to the lessor. All right. Now, in this case, the lessee will include the executory costs as part of the lease liability. All right. So, when we have a gross lease, the lessee is making fixed payments to the lessor, and the executory costs are included in the lease payments. So they're part of the lease liability. Now, when it is a net lease, the lessee makes variable payments to the lessor, variable payments, or to third parties. All right. Now, in this case, if it is a net lease, the executory costs are expensed by the lessee. Gotta know that. Okay. Now, then we have these initial direct costs. Now, what are initial direct costs? I'm reading definition here. They are incurred by the lessee/lessor only because the two parties entered into a lease. Now, what's some examples of initial direct costs? Commissions to brokers. All right, payments made to an existing tenant to terminate the lease or to move out. All right, and remember, a cost that is not considered initial direct costs are generally the general overhead, all right, the salaries, the advertising, and the evaluation of any prospective lease lessees. All right. Now, please remember, these costs, which are the general overhead, salaries, advertising, they're not initial indirect costs. All right. So therefore, what do you do with them? All right. If they're not initial direct costs, all right, you do nothing with them. Please remember that. You do nothing with them. Now, please note, let me just make sure. Well, I take that back. All right. They're not part of the lease. Let's just put it that. If they're not initial direct costs, they're not part of the lease. They're just expensed. All right. Overhead is an expense. Salary is expense. Advertising expense. But it's not part of the lease expense. Now, if you have initial indirect costs, you capitalize them when you record the right of use asset. So initial direct costs are capitalized to the right of use asset, all right, but not to the lease liability. The lessee will debit when they actually capitalize initial direct costs, all right. The lessee will debit right of use asset and credit accrued expenses because they don't go to a lease liability. All right. Now, the next blueprint, all right, it says, prepare journal entries that the seller lessee should record for sale and leasebacks. Now, this has also been changed, all right, because the only time you have a sale and leaseback is when, all right, we have a sale by the lessee. I'm sorry. All right. We have a sale. I'm getting confused here a second. I apologize. All right. We have a sale. All right. Now, what's the sale? The sale is from this. All right. Let's assume Phil needs cash. I need cash. I have an asset. So I'm going to sell the asset to Bill. All right. Now, Bill doesn't really need the use of the asset. So Bill leases it back to Phil. Now, if Phil leases it back as an operating leaseback, they consider that a sale and leaseback because, all right, I am actually doing what? I'm selling it to Bill. Phil, I'm selling it to Bill. All right, now I'm going to record a sale, but Bill is leasing it back to who? All right, to me, Phil. Now, I am not getting control of that asset anymore. Why? Because when I, Phil, sold it to Bill, I gave up control of the asset. So if I lease it back as an operating lease, I'm just using it. I don't have control, and that's considered a sale and lease back under the new rules. Now, if I sell it and lease it back as a finance lease, it is not a sale and lease back. Please remember that. All right, and the next thing, all right, and we're going to talk about this. Here's the next blueprint. Interpret agreements, contracts, now this would be for the simulations. Interpret agreements, contracts, and or supporting documentation to determine the appropriate accounting treatment of the leasing arrangement and to prepare the journal entries that the lessee should record. So they're going to give you documents. You have to determine whether it's a what? All right, to the lessee, a finance lease or an operating lease. And remember, the way you'll interpret that is you're going to look in the documents whether those owns requirements are met, right? But remember, the end test is that the present value lease payments has to be substantially all. Look for that wording, all right? And the 75% test presumes that the lease term is a major part of the economic life. So you look at one of those. And if lessee meets one of those, it's a what? Finance lease. Good. All right. Now, the next thing says, recall, I'm reading the blueprints, recall the appropriate accounting treatment for residual value guarantees, purchase options such as a bargain purchase option, and variable lease payments included in the leasing arrangements. Now, we have gone about 20 minutes, all right? I don't like to go over that, but, all right, I will tell you this, all right? When you have, there's two types of residual value guarantees. There's unguaranteed residual values, which means the lessee does not guarantee the residual value at the end of the lease. And there's guaranteed residual values at the end of the lease by the lessee, all right? Now, please remember this. The lessor's accounting treatment, their accounting treatment for guaranteed and unguaranteed residual value is the same. It's the same. It's the same. Now, if you have a bargain purchase option, the lessee will record the asset, the right of use asset, at the present value of lease payments, all right, if there's a bargain purchase option, plus if they're going to buy at the end of the lease, they're buying a lump sum amount. So today, what are they paying for that bargain purchase? They're paying the present value of the lease payments, and also they're adding to that the present value of $1 table of the bargain purchase amount. All right, that's the way you treat bargain purchase options. All right, now, what is a variable lease payment? Well, all right, we have fixed payments, which are same every period, but there's variable payments. And variable payments are, for example, let's assume you have a store in a shopping mall, and if your sales exceed a certain amount at the end of the year, then your lease payments will go up for the next year. All right, or if it says your lease payments go up each year based on the consumer price index. Now, please remember this. Both of those are unknown. Those variable lease payments are unknown. All right, so if they're not known, all right, what happens is this. When you calculate the present value of lease payments, all right, if the variable payments are not known when you enter into the lease, then ignore them for calculating the present value of lease payments. But let's assume it says this. All right, here's another example of variable lease payment. All right, at the end of the first year, the rent will go up $15,000. Well, you know that when you enter into the lease? Yes. So if you know it, and the lease payment the first year is $500,000, and it's going to go up at the end of the year to $515,000, all right, you're going to take the present value of $515,000. So when you know the increase in the variable payment, then you make it part of the lease payments. Please remember that. All right, and that, I think I've covered all of the blueprints. But I just want to show you once again, you have to know the lease payment. You have to know the lease payments. You have to know the blueprints, all right? If you don't know those blueprints, how do you know what they're going to ask you? All right, remember, there's blueprints for every part. There's blueprints for financial. There's blueprints for reg. And you know what? They tell you very specifically what you have to know. And there's blueprints for auditing and BEC. If your course does not integrate them, all right, and when I talk about integrate them, I'm not talking about give you a copy of the blueprints or maybe tell you, hey, here's some multiple choice that appear for that. When we talk about integration, we talk about integrating our text within the blueprints. That's a big difference, okay? If they're not doing that, all right, you're going to have a lot of problems, all right? Make sure you at least go to the AICPA.org website and look for the new blueprints. You can copy them. They'll give them the blueprints just like I read them to you, but obviously they're not going to tell you the material and give you, a text of the material that is covered under that blueprint. But at a minimum, make copies of the blueprints. So if your course does not give you the copies, all right, or doesn't mention them, if they don't mention them, I don't know where they were. We're at the same meeting every year, twice a year, where the AICPA says, know the blueprints. Now, not every course is invited to appear with the AICPA, all right? Only about 5 courses, all right, that are really CPA review courses and not bloggers or not companies that, just rate this, the different courses, all right? By the way, read the fine print on those ratings. It might say on the bottom, all right, that they are compensated for doing these evaluations. Okay. All right. So anyway, all right, that covers it. I hope that helps. And I would appreciate your comments. And tell me what else you'd like me to go over. I'm willing to do them anytime, either in a webcast, a webinar, or I can talk about them in a Facebook Live video. whatever helps you. And remember, you can always call Phil Yaeger, even if you're not in this class. All right, and that's another thing that burns me up. These people, I asked them, what do you do when you have questions? They had no one to call. That is sad. We don't sell a product and then say good luck. Hey, I want to help you. You have to have someone to lean on. All right, so I allow people to call me 7 days a week at a minimum. You know, CPA review business has changed a lot. All right, I'm not going to change. I will continue to give service and to help the students because I know it's a very trying time going through the exam. And you know, you need someone to talk to and to lean on. Ladies and gentlemen, I want to wish you a happy, healthy new year. And I want you to please pass the CPA exam for yourself and also do it for me. You know, I like to hear that you pass, even if you're not in our class. So anyway, take care, everyone. Thank you very much.